You're welcome to today's lesson on the national income, a topic in macroeconomics. What is national income? National income is not the total volume of goods and services produced by a country. Neither is national income the total amount of money existing in a country. Because I know most students always give this explanation or this definition. National income is simply the financial value of goods and services produced by a country's resources in and out of the country. The financial value of the goods and services produced by a country, not the volume of goods and not the amount of money existing in the country. So we are going to be calculating, showing how to calculate national income using three main approaches. We have the income approach, the output approach, and of course the expenditure approach. And either of this approach, indiscriminate of which one you use, it should give you the same answer. That is to say that if you use the expenditure approach, it should give you the same value of national income for a country as the same as the value for the income approach, same as the value for the expenditure approach. That is what we call the national income identity, which states that the national output should be identical to the national expenditure, which should be the same as the national income of the country. So that is what we call the national income identity. The total value of a country's output should be the same with the expenditure spent to realize that output, and its income in terms of that output should also be the same with the expenditure and the output itself. Let me give you a practical example. If an individual has used resources worth 100 francs to produce this ink, this pen, and the person has paid labor to produce this pen for 100 francs, such that the total expenditure he has made on this pen is 200 francs. Raw materials 100 francs, labor 100 francs, making the total expenditure to realize this pen being 200 francs. It means that the value of this person's output in terms of this pen, the value of this output in terms of this pen is 200 francs. And then his income that he has in terms of this material pen is also 200 francs. You have spent 200 francs to realize an output, and the financial value of that output is 200 francs. Then your income that you have in terms of the financial value of your output is also 200 francs. We call that the national income identity. But then, calculating national income using the output approach, expenditure approach, and income approach have different formulae. Let us see what that is all about. Let's start with the expenditure approach. Okay, the expenditure method, just like it sounds, it is all about the sum of all expenses made in order to realize output in an economy. It is the summation of expenditures made by the various stakeholders in a country. That is, consumers. How do consumers spend? They spend through consumption. When you buy goods and services, we call that consumption. That is how you spend as a household. That is how households spend. And then how do firms spend, or businesses? They spend through investment. When you want to produce goods and services, as an investor or a businessman, you need to hire factors of production. We call that investment. And in order to invest, you need to spend. And then the government also spends. How does the government spend? The government spends by providing public and merit goods and other expenses that we call G. We will be calling government expenditure G. And then we also have expenses both by firms and the government, and even individuals or households in terms of import and export. These three persons, the government, businesses or firms, and then households also spend on imports. They both spend on exports as well. So how do you calculate national income? We shall be taking it step by step. We have the very first thing to do is calculating national income using the expenditure approach. You have the total domestic expenditure, which is a summation of all expenditures that are made domestically or made at home in order to produce goods and services or to consume goods and services. Consumption by households is denoted by C, or expenditure by households is consumption and it is denoted by C. Expenditure by firms is investment denoted by I, and then expenditure by the government is denoted by G. So the total domestic expenditure is given by C plus I plus G. And then the next step, you look for your total final expenditure, which is simply the consumption that is done at home, even on goods that are going to leave the country. All consumption done at home, even on goods that are going to leave the country. So only one thing changes here. Only exports add to total domestic expenditure. So total final expenditure is consumption plus investment plus government expenditure plus export. Or since C plus I plus G is the formula for calculating total domestic expenditure, you can say that total final expenditure is equal to TDE plus X. And then we have gross domestic product or gross domestic expenditure, GDP, which is simply consumption plus investment plus government expenditure plus export minus import. So the only thing that has changed here is that we have added import. That is, imports are being used here. We have subtracted imports from the total final expenditure to have the gross domestic product. And then the fourth stage is to look for our gross national product, what we call the GNP, which is of course consumption plus investment plus government expenditure plus exports minus import plus or minus net property income from abroad. What is net property income from abroad? Net property income from abroad is simply the difference between property income received from abroad, that is income that Cameroonians, for example, receive from abroad from their resources which are found overseas, and then property income paid abroad, which is income generated by foreigners in Cameroon. You know, foreigners have invested in Cameroon, and then whatever their industries or their companies generate does not belong to Cameroon. So that is property income that is supposed to be paid out of the country. So in order to have net property income from abroad, you take property income received from abroad minus property income paid abroad. The difference gives you net property income from abroad. And then the final and fifth stage to calculate national income, or we say net national income or net national expenditure. Since we are under the expenditure approach, you see consumption plus investment plus government expenditure plus exports minus imports plus or minus net property income from abroad minus capital consumption, or we call it depreciation. So this is the complete formula for calculating national income using the expenditure approach. Or if you do not want to go through all of this, since you have already calculated your GNP, what you can do is that you just say that your national income is GNP minus depreciation. Or you want to calculate GNP, instead of going through all of this procedure, you just say that GNP is equal to GDP plus or minus net property income from abroad. Instead of going through the procedure of getting GDP by summing everything, if you have been working in stages already and you have had your total final expenditure, if you want to have GDP, you just say that GDP is equal to total final expenditure minus import. So that is how you calculate national income using the expenditure approach. Now we are going to see an exercise in our next lesson. We are going to see an exercise that is actually a past GCE question and see how to apply all of this.